Okay.
Good morning.
Good morning. It looks well. Kia ora, everyone. It looks looks like most of you are connected. Yes. Good morning to you. Welcome to session 3. We'll be talking about digital trade today. And we have 2 guest speakers with us today, Haiping Zhang and Rob Scholar, who you know from last week. So before I hand over to them, I will, as usual, just begin with a short karakia to bring us all together. Mori oho, mori tu, mori ora kia tato, homie, huie, tai kie. So yes, it is my great pleasure to introduce Haiping Zhang from our business school. And Haiping, I will hand over to you.
All right, so I think I have the share. I can share the slides, right?
Yes, your co-host.
Okay. Let me find the sharing button. Can you see the screen? I hope that right. So hello everyone, welcome to today's session. So I'm Haiping Zhang. I'm from University of Auckland Business School. I'm a senior lecturer of economics in the economic department. In the meantime, also serve as co-director for New Zealand APEC Study Center. We belong, which is housed under the New Zealand Asia Institute. So in today's talk, I will probably give you a brief overview about the recent development in China's digital economy, and especially about its progress in the last decade, and what kind of future prospects that China digital economy would present to the rest of the world. And in the end of the presentation, I will briefly talk about China's digital trade. Now let's start with the first part. So in this first part, I will give you an overview about dramatic increase of China's digital economy in the last decade. So let's start with one chart. This is the very famous chart that appearing in many media these days. So it records the market size, the change of market size in China's digital economy since 2005. So if you look at the market size in trillion Chinese yuan, Chinese currency, it has been increasing from 2.6 trillion Chinese yuan in 2005 to almost 20 times to 45.5 trillion. So let me give you a rough idea about how large this number it is. It's roughly $7 trillion in 2021, accounting for roughly 40% of China's GDP. However, I have to mention that the digital economy measured in this, showing this table, is reasonably under the wide, broader definition. So it includes the transactions that utilize the digital technology. Does not necessarily relate to the digital service that we talk about in a strict sense, right? So anything that, for example, when you are selling the product online using digital platform, that transaction amount will be included into this statistics. So all the value added part will be included in this statistics. But anyway, for that figure is pretty large. And according to a recent ING prediction, so ING is a company investment banks in Netherlands. It predicts that China's overall digital economy could be valued at $99 trillion Chinese yuan by 2030. So again, doubled in the next 10 years from 2021 to 2030. So with average growth rate of 16%, which is pretty enormous. And if you put China versus the rest of the world, you see that in 2021, you can rank total value of digital economy of the G20 countries. So you see that US is leading the world. It is the digital economy in the US is roughly $15 trillion, while Chinese digital economy is only half of that, and followed by EU and other economies. So given that both China and US has been leading the digital economy in the last decade, we expect to see both of the economy will continue to lead in the growth of digital economy. Now, recently there is an interesting report by McKinsey Digital. So McKinsey is a consulting company. They have published a report on the future of digital innovation in China 2 years ago. So in this report, McKinsey company identified 4 interconnected contributing factors behind the dramatic rise of China's digital ecosystem. So the first one is, of course, the huge digital consumer base, including not only referring to the huge population size in China, so 1.4 billion population in China these days, but also how interconnected this the Chinese consumers through the digital infrastructure. That will briefly touch upon in the next few slides. And the second factor that contributing to China's digital economy is the immense pressure for digital firms to upscale at national level. So interestingly, you see that most of the big tech companies in China, they are not operating at any province. They are operating at a national level. So in the sense that they are competing on the very beginning on the national level. And in the meantime, we have to emphasize that the dramatic rise of Chinese economy is driven actually by the market-based approach rather than by the government-sponsored approach. In a way that you can see many stories behind the Alibaba, Tencent, which are the big tech company in China, regarding how much they are involved with international investors. Their substantial increase in China's big tech company is supported or facilitated by the international capital. So through the venture capital industries, mostly private sector, play a critical role behind this dramatic rise of big tech companies. In the meantime, we have to also notice that the government also play a very important role in this process. So we will talk about exactly what we mean by this in the next few slides. Let's first look at some data. So the first table or first chart shows you the number of online population in China in the last 10 years, from 2010 to 2021. So you can see clearly that in China, the internet users was around slightly below 500 million population in 2010. However, in 2021, the total number of population online is already exceeding 1 billion. So in other words, roughly 70% of population in China is already online. So interestingly, you see that internet connection refers to wired or wireless connection. Mobile users was initially fall below the number of internet users. In other words, there is a big chunk of users who have been using wired connection through to internet. However, if you look at number in 2021, almost all consumers who are connected online, they are using mobile device. So of course, people use multiple devices. They probably also connect online at home through computers, through iPads, through mobile, but mostly they have mobile device. So that actually is a very important the technical foundation for the substantial increase of digital payment system in China. And if you look at, of course, China is a big country. There's what we call urban-rural gap in terms of economic development. However, if you look at the internet penetration rate, which refers to the amount of fraction of population in the urban area or in the rural area who are already online. So if you look at a number in 2021, almost more than 80% of people who are living in urban areas, they're already online. And in the rural area, some of the rural area could be very remote area. However, nearly 60% of the rural area population has been already online. So this is a very important number, I think deserve attention. So if you look at recent development in the urbanization process in China, by the end of 2021, nearly 2/3 of population in China has already been in the urban area, while only 1/3 of the people still living in the rural area. If you look, then taking that number into account, you will see this number has a very profound implications for the market size of digital economy. The next one is really about the cost part. The first chart we show you, the first two charts shows you the digital infrastructure in terms of how well people are connected. through internet in China. The second, this chart shows you the cost. So of course you can say, well, people are connected through internet. However, how often people use the mobile device, how often people use internet, it also depends on the cost, right? So if you look at the dollar price for per gigabyte mobile data in 2015, 2014 versus 2021, you will see there's a substantial decline of the cost. So in 2014, 2015, you cost maybe $15 US dollar to get 1 gigabyte data. And just now I checked some data online. It says that it costs you $30 US for 60 gigabyte 5G network data per month. So that is symbolized a very substantial decline. So almost half US dollar per gigabyte. So this is symbolize a very dramatic decline of the cost of data use. And in the meantime, you can see that the number of 4G station, the 5G station in China has increasing dramatically. And 5G is the current next generation of mobile network, has been starting in 2018 and also increased dramatically. And data only shows you number 2021, and in 2022 the number of 5G stations also increased dramatically, but we don't have data yet. So if you look at, as I just mentioned, people have nowadays in 2021, almost all consumers who are connected online, they will be using the mobile device, like a smartphone, like iPads or other device. Well, people still use other options like a desktop PC. So if you work at home, work in the office, you probably still use a mobile PC sometimes for work, for study. However, if you're on the way, you probably mostly are using mobile phones. And it seems that everyone has a mobile phone. And that is a very interesting story about the dramatic penetration rate, increase of penetration rate for mobile device in China. So I guess you probably heard about the story of Xiaomi and other smartphone producers in China, which offers relatively low cost smartphone that is roughly half the price or 1/3 of the price of iPhone or Samsung flagship phone, but at a very good quality. So this actually is another factors that stimulate or gradually substantially increase the usage of mobile device in China. So these are both in terms of mobile network station, but also the cost, the competitive price for the mobile device that drives this kind of internet access. And interestingly, that if you look at the retail sales that utilize internet or online platform, this e-commerce share has also increased dramatically. In 2011, if you look at the penetration rate for online shopping, basically says that among the people who are online, how many people are using they're using this internet for shopping purposes. So in 2011, less than 40% people online are using internet for shopping. In 2021, this number already exceeds 80%. So that's a big increase, almost doubled in terms of fraction of population. And if you look at e-commerce share for retail sales for consumer goods, it has also increased steadily. So in 2021, 2020, 2021, which was during the pandemic, people will say, well, that makes sense because on the pandemic, people probably don't go shopping in person, probably order things online, more likely. During that time period, or even before pandemic, in 2019, already over 20% of China's retail sales in consumer goods were conducted through online platform. So that's already a very dramatic number. And let me give you a few interesting examples. So I guess if you are familiar with China digital commerce, you probably heard about Alibaba and Jingdong. These are the two biggest online platform for shopping. So Alibaba actually initiate a very interesting or funny day as November the 11th. They call that a Singles Day because November 11th, they are 11, so basic single days. So it's a kind of coming from very funny joke about people who didn't have a boyfriend, girlfriend, or partners. So what they do during that day, they have created a holiday for shopping. So essentially, this Singles Days becomes shopping festival in China, unofficial. It's mostly among young generations. And however, over the years, you can see clearly that the transaction volume on this single day, one day, November 11th, has increased dramatically. And during the pandemic, this Singles Day transaction volume already exceeds $80 billion in 2 days, within 2 days. That's a dramatically huge volume. In the meantime, that is only the Alibaba's Singles Day online shopping festival. And Jingdong initiated another day is in June 18th. They call that another Jingdong shopping festival. And it seems that they have also triggering substantial increase of sales volume on that day by Jingdong, another online shopping platform. So these 2 days become nationwide unofficial holidays, and many people actually wait until these 2 days to buy some electronic equipment, buy a new iPad, buy a new computer, some other device. So that actually leads to a dramatic explosion of the transaction volumes. But also these two shopping festival also symbolized how exciting, how interesting people are waiting for these 2 days or for the 2 years. Very much like in the US, there is a Black Friday. So that actually also give an enormous amount of discount. You probably can buy many electronic equipments at the discounts. And same idea also applies this to shopping holiday in China. And this is what we call new form of e-commerce. So traditionally, if you go to Alibaba, go to Amazon, go to other eBays, you can buy things there, but you will mostly see the description of the product in words, and also you probably click the link that brings you to the product, and then you just order that. That's what we call traditional online shopping method. However, in China, in the last three, I think 2018, 2019 onwards, you can see clearly there are a lot of new format of e-commerce. For example, people are actually coming up with, they are not actually shopping on the platform with words. They are actually have a live streaming on their shopping platform. Every shops is actually framed as a booth, online booth, that people actually promote their product to the customers and over the entire days. And when people like this product, they will make the order immediately. So this kind of live commerce created kind of interaction between sellers and buyers. So it's very much like a real world scenario that when you go on Friday or on Saturday, weekends, probably go to the weekend market to buy some fresh vegetables or food made by some household farms. So you actually not go to the weekend farm market. Instead, you go online. You will see very much the same thing. People talk to you online. So this is a very new format for e-commerce. And if you look at the live commerce, the number of transaction volume has also increased dramatically. In 2008, 2021, it increased over $350 billion. That's a huge amount. And in the meantime, they're also called the social commerce. Social commerce basically says that if you are using some social media like Facebook, other things, in China, people use WeChat. So when you are communicate with your friends, you have a friend circle. So sometimes if you find something really nice, you can recommend that to your friends. And if you are some kind of opinion leaders on the social network, you will have the chance to promote the product to the people who subscribe your channel. And this is has proved to be a very effective way of promoting the products to a very specific customer group. And you can see clearly that social commerce also increased, the transaction volume under the category of social commerce also increased dramatically. So these are what we call new form of e-commerce. And if you look at this type of e-commerce, this e-commerce are mostly welcomed by the younger generation. So like Generation Z, who were born after the millennium, and then for the older generation, you will see that people still prefer the traditional e-commerce. However, for the younger generation, they are spending more time on the live commerce, through social commerce, through other new format of commerce. However, if you look at in the next 10 years, when this younger generation become the mainstream in the customer group who has a purchasing power, so you can imagine that this live commerce will become a new habit of consuming for spending in China, and this is actually symbolized the trend for future e-commerce format. I have talked so much about the current the business format in China regarding e-commerce. There is one important aspect, I guess everyone need to be aware that when you are conducting e-commerce, you have to think about how to make the payment. And if you look at buying things on Amazon or other online platform, that's easy. Just provide your credit card, and then you buy stuff online. However, many people in China, they are not using credit card. They don't even have credit card. So therefore, they need to use their digital wallet. They use their digital wallet attached to their social media app, like WeChat, like other social media apps. And this kind of app-based mobile payments system allow people to pay on the go. They don't have to sit in the room and make the booking, make the ordering online through computer and press the button using their credit card. They are actually pay the things on the way during when they are on the way on the tram, on the underground trams. So this symbolize a new way of payment in China. So if you look at the number of mobile transactions in billion units, you will see that this mobile payments was almost didn't exist before 2012, very little. However, if you look at in 2020, the number of mobile transactions already reached 120 billion transactions in 1 year. So this is the transaction does not refer to something that related to any buying selling behavior. It's also related to something like people in China when they give some gifts to friends, like hongbao. This is kind of red packet during the Chinese New Year as a good wish to friends. They always transfer this something like $1, $2, $3 through mobile device. And this is also counted a number of mobile transactions. So in other words, the digital payment or mobile payment has already become part of the lifestyle in China. So in terms of value of a mobile transaction, so it's also around 60 billion US dollar terms. So this is a huge market there. And if you look at how often people are using their mobile phone for payments in China in 2022, so according to a recent survey by Daxue Consulting, so more than half of the population who are using mobile device, they will make mobile payment at least 1 or 3 times per day. And a third of them, they will use mobile payment more than 3 times per day. So that's a lot. Basically, that's what I'm saying, that mobile payment become part of their daily life in China. So anything, if you go to buy something from the dollar shop, you make payment. If you buy something on the road, so if you go to the supermarket, you pay things using your WeChat or using Alipay, or you go on the road, on the street. If you want to get some snack on the road, on the street, you can also pay using your mobile device. The people don't accept cash, or I would say many people don't accept cash nowadays, or they are not they're probably reluctant to receive cash. Instead, they are paying everything through mobile phone, receiving cash or paying cash, receiving payment or making payment. They all use mobile phone. So this is an interesting phenomenon that we have observed in China. So if you have a car driving through some toll station, you also make payments through mobile phone. So you save time, and also you can keep track of everything in your app. And this is something that it is worthwhile to mentioning here. So if you look at the payment method in China, so before 2016, most people using debit card, not credit card, but debit card for payment. However, since 2016, you can see a dramatic increase of the use of Tenpay. Tenpay is basically Tencent is another big tech company in China. Alipay is Alibaba company. So these are two major mobile payment providers in China. So their share in China, the transaction volume through these two apps has increased dramatically. In the meantime, you can see the transaction volume conducted through credit card was very limited anyway. So it becomes obvious that China actually take another road in terms of mobile payment. Instead of using credit card, these apps become dominating way of making payments in China. So this is dramatic, right? However, if you look at many emerging economy in Asia Pacific areas, you see China is not really alone. So if you look at this chart, actually shows the relationship between the credit card penetration rate versus the share of e-commerce payment via digital or mobile wallet. So credit card penetration rate basically says that how many people in the society they have the credit card. So if you take New Zealand, for example, New Zealand has roughly 60% of population in New Zealand, they have a credit card. So they could use that for daily payment. And in Japan, the number is also higher. And if you look at in this group, this is emerging economies in Asia Pacific areas, including Thailand, Malaysia, Vietnam, Philippines, Indonesia, and India. So you see many of these emerging economies, the credit card penetration rate was very, very low due to the underdevelopment of their financial system. And similarly in China, the credit card penetration rate was also low, below 20-25%. However, if you look at the share of e-commerce payment via digital wallet, you see that in New Zealand, only 20%, 25% people using their digital wallet, mobile wallet for payments. This is very much the same, or even in this emerging economy, people tend to use more of their digital mobile apps for payment. So this is an interesting phenomenon, saying that people argue that there's a kind of phenomenon called the advantage of backwardness. So in the emerging economies, in comparison with advanced economies, their financial system is not very well developed. However, in the meantime, they have two options to go. The first option is that follow the advanced economy to implement the credit card system to facilitate payment. However, there's another option nowadays, which is make payments through digital apps or mobile apps. So given the technology barrier has been declining dramatically in the mobile payment apps, so many of the emerging economies start to implement this digital payment rather than implement the traditional credit card system. So this observation is particularly dramatic in China. If you look at China has roughly 80%, over 80% of e-commerce payments were conducted through digital or mobile apps. So this is a very interesting. I guess this is probably also be similar in many of the Africa countries, I guess. So with the digital technology become more and more accessible to the larger population in the economy. So it is more likely that people will use a switch to the newer technology, which is digital app, rather than go back to the traditional credit card system. So that will trigger substantial pressure for financial system to upgrade and to innovate, to keep up with this new technology progress. This is some lessons that people have learned in the recent decade. So when we are talking about digital payment, obviously, you see that when you make digital payment, you have to go, the funds has to come from your bank account. And then this fund will be transferred to your digital app. And of course, when you after purchase, you probably won't completely use the amount of money that you transfer to your apps. So for that case, there is still some money landed in your apps, but maybe next week, if you want to buy something else, you probably can use the unused balance in your digital app. And if you look at what happened in China, this is a huge amount of money if data has been sunk in the digital apps. So if you look at Alibaba, when they initiate Alipay become very popular mobile payment device. And of course, when people maybe transfer $100 into their Alipay account, and when after the payment, probably there's maybe $50 still left in their Alipay account. So if this money just sleep there, it doesn't create any value. It doesn't bear any interest. And of course, Alibaba as a financial innovative companies, they have been thought about how to make money from this unused balance in the individual accounts. So in 2013, they launched a very interesting financial product called Yuebao. Yuebao basically is another account, I would say another account parallel to Alipay. Alipay is for payment purposes. Yuebao is another like a savings account within this big app. So if you have unused balance in your Alipay account, you can transfer this account to Yuebao. And then Alibaba is offering this kind of interest-bearing service for this Yuebao, the money which you put into Yuebao. And how do they use this money? So they actually partner with asset management company and a money market fund company in China. So Tianhong, basically the Tianhong funds, they launch money market fund called Tianhong Yuebao money market fund in 2013, and they offer the market interest rate for the money in this Yuebao account. So how large is this interest rate? So in 2013, this interest rate was around 6%. In the meantime, if you put money as a deposit at the bank, this bank deposit will offer you roughly 2% or 3% interest rate. So obviously, putting money at the Yuebao account will give you almost twice as much as the interest rate you can earn on the conventional commercial bank account. And this huge interest rate differential attract huge amount of users to subscribe this Yuebao account. So that also stimulate people's transfer money first to Yuebao and then first transfer money to the Alipay and to the Yuebao. This way, you can think of Yuebao not only offering the Alibaba's customers or clients a high interest rate, also this financial product increase the consumer awareness of Alipay and also Yuebao. So eventually, it's bring new customer, huge amount of new customer to convert them to the e-commerce users. So how much this money market funds look like? If you look at this number, it basically shows that this excess high yield, high interest rate gap brings Yuebao a huge amount of customers. And just 4 years later, Yuebao actually took over the JP Morgan US government money market mutual funds in 2017, become the largest money market funds in the world. So with asset roughly 117 billion US dollars. So that already exceeds become largest money market funds in the world. So how could they do this dramatic move? So one of the reasons is that in China, if you want to, before Yuebao was launched, if you want to invest in the money market funds as individual consumers, you need to put in something like 50,000 Chinese yuan. So roughly, I would say roughly $8,000 as a startup, as a minimum investment requirement. However, the Yuebao actually bring down this minimum investment requirement from $8,000 to roughly 20 cents US dollar, 20 cents. So that reduced the entry barrier for almost everyone. So it make this money market funds accessible to everyone in China. So this is a very dramatic financial innovation. And so if you look at the, so of course, if they have this huge amount of funds invested in the money market, they can earn some interest and also bring profit to the Alibaba company or Alipay company. However, this amount of return is still relatively limited, because money market funds offer you very safe return. However, the safe return, but the return is relatively low in comparison to other investment opportunities. So then Alibaba decided to think about, maybe they want to come up with a more aggressive financial services. So in 2014, Alibaba actually relabeled this Alipay, this company, into Ant Group service. Does this Ant Group ring the bell to some of you? So if you follow the news in 2020, you probably heard about the Ant Group was initially planning its IPO in Shanghai, in Hong Kong simultaneously, and could become the world's largest IPO ever. So its market capitalization is around multi-hundred billion US dollars. However, this IPO was put on hold on the last day, virtually speaking, on the last days before this IPO was planned. So there's a lot of discussion, a lot of conspiracy theory behind these events. However, in retrospect, from today's onwards, if you look at this phenomenon in retrospect, you will see a lot of interesting facts. So in this case study, I'm going to briefly show you what, from the economic point of view, from financial stability point of view, how could Ant Group grow so fast, become a financial conglomeration in a very short time period, and why the Chinese government put this on hold in 2020, right? So this Ant Group has been so supported by these fintech, financial technology that has been highly featured in many mass medias these days in the last few years. So one of the things they are involved with is online lending and other financial services. So in 2020, just give you a rough number about that. In 2020, the Ant Group actually has the largest business category called lending services. There's normal lending services, and the amount is 253 billion US dollars in consumer loans and 61 billion for small business loans. So one thing I have to mention that Ant Group is not does not offer loan to large companies, to traditional companies. They are mostly offering loans to the customers who could have difficulty in getting loans from conventional banks. So if you look at their customer base, they are mostly offering consumer loans and small business loans. Both categories were not very popular in China's financial market, because conventional banks, they don't have sufficient information about the consumer's credit worthiness, and also they are not very sure about the credit worthiness of small business. However, Ant Group has a particular comparative advantage or competitive advantage in these two categories. So still remember, Ant Group was built upon the Alipay, and Alipay is mobile payment device for the Alibaba company. the largest online shopping platform. So for the consumers who have been buying stuff on this Alibaba platform, they need to provide their address, provide their personal information to Ali company. And of course, if they buy things, they don't buy that just once for their whole life. They probably become frequent buyers on the Ali platform. So the more they purchase consumer product, purchase a product on the online platform, they actually show their transaction record has been stored in Alibaba's platform. So it becomes very important, valuable assets for Ali company to utilize, to synthesize this information, to evaluate consumers' creditworthiness. So if you always make a payment on time and proper and become frequent buyers through Alibaba company, Alibaba's platform, you will be rated as a creditworthy customers. Similarly, if you are small merchants, which are selling product on this platform for 2, 3, 4, 5 years, and you always deliver the best quality product at a competitive price and receive very high customer evaluation, and you never get too much complaints on that, and customer rating is very high, so you will be rated as a highly creditworthy merchants. For both group of clients, so Alibaba collects enormous amount of information, and the nice thing is that they actually can offer loans to these two group of clients, both the buyers and sellers, when they are in when they need short-term loans. So if you are consumers, if you want to buy some smartphone, but you don't have sufficient funds these particular months, but if you always make payment in the past, the Alibaba will grant you the loans, consumer loans, very easily, because you have proved yourself to become creditworthy customers. And it's very likely that you will make a payment in the next 2, 3, 4, 5 months. Then you will get a loan easily. And similarly, for small merchants, they can easily get a loan from this Alibaba platform as long as they have been running their business very well in this platform in the past. So this is a very interesting. Intuitively speaking, it's very easy to implement. And luckily, the Alibaba company has been utilizing the artificial intelligence and big data analytics, cloud computing, all these modern techniques. Alibaba created a very interesting online lending model. So it's called 310. The 3 refers to 3 minutes for loan application. So if you want to, as a customer, as a consumer, if you want to buy some product online, you just spend 3 minutes to fill out online loan application form. And then it takes 1 second for loan approval. And there will be no human intervention. So in other words, this loan application will be assessed automatically by this online lending platform by tracking your previous transaction record and then make a loan approval decision very, very quickly. And there's nobody actually doing this. There is no human intervention, human interaction through the loan approval process. So this very efficient and highly precise online lending model has a huge implications. So if loan application requires individual personal evaluation, probably there are some mistakes. However, if this loan approval has been done based on the previous transaction record you have accumulated on this online platform, then the outcome is very precise in the sense that given the gigantic database of transactions and spending patterns, and also payment behavior and all the other data recorded there. So Alibaba has made very precise lending decision or precise or correctly lending decisions. In other words, the default rate of these loans is constantly below 2%, which is astonishing number for the conventional banks. So conventional banks, if they have the default rate below 2%, they should already celebrate. It's a very big achievement. But this achievement has been done through machines, through the AI. So let me show you a very interesting some interesting numbers. This was some numbers calculated by Bloomberg in 2020, shortly before the Ant Group's IPO was put on hold. So Bloomberg anticipated that Jack Ma's Ant Group will become the financial conglomeration and with a few categories of assets. So the first category is asset management, and second one is about lending, and third online payment, and there's and the third branch is the insurance. By looking at this number, you can see how much these online financial fintech platform has been engaging with financial transactions and also involve the amount of customers in China. And so this Ant Group, by running such a very, very profitable business, because most of their loans to the are lending to their customers, which has been ignored or declined by the conventional banks. Now, through the Alibaba's platform, online lending platform, these customers or consumers or small merchants, they have access to financial service. It's a great achievement in terms of financial inclusiveness. So leveraging this modern technologies. So of course, if this is a big profitable business, become very safe business, and then the next step, if you are doing corporate finance, you probably know what to do next. When if you are the CFO of Ant Group, you probably don't want to just use your own money to run this business, because this is a very high profitable business and also very safe, and no one else can do that. And what you could do, you probably want to partner with conventional banks and utilize the cheap funds that you can get from these conventional banks and doing some leverage lending. So in the way that, suppose I lend out $100 to my small merchants and consumers, and I can get a loan which bear interest rate of 10%, suppose. Because this customer, they can never get a conventional bank loans from conventional banks. Therefore, they are willing to pay the annualized interest rate at 10%. And as Alibaba, and you have proved to the banking sector that the default rate of your business is very, very low. So obviously, the banks would like to lend you the money at a reasonably low rate. Suppose the bank can lend you the rate at 2% or 3% a year. So for every $100 I lend out to the customers, I get $10 as interest. And if I can borrow $50 from the banks, from the commercial banks in China, so I only need to pay $1. If the interest rate is 2%, I only need to pay $1 to the banks. And among these $10 I get from customer, $1 go to commercial banks, and the rest of $9 is my net profit. So, but I only pay out also, I only put $50 because another $50 coming from commercial banks. With the $50 I put into this loan business, I earn $9 per year. That's 18% interest. So this is the power of leverage lending. So obviously, this sounds still okay if you are lending $100 and borrow $50 from the bank. You also chip $50 in your business. This is allowed according to the financial regulation in China. But interestingly, this is not the limit what Ant Group have been doing. And Ant has been putting not 50% of the loan on their own balance sheet. They only put about 2% of the loan on their own balance sheet. In other words, for every $100 they lend to the small merchant, to their consumer loans for their consumers, so they actually borrow $98 from commercial banks in China. They only put $2 from their own pocket to this business. So you can count how much is the rate of return on their lending business. This is huge. So that's why the Ant's financials IPO was so much chased by all the investors in the world, because they have very profitable business model. And you can calculate leverage multiplier. So it's roughly 50. So for every $1 from Ant Financial, they can mobilize $49 from China's banking sector to support their business. So this is a very, very dramatic business model. And however, this very skewed debt to the asset ratio eventually caused the concern by the financial regulator in China. And in particular, this Ant Financial's algorithm-based lending and securitization model, and supported by fast expanding funding network through China's commercial banks or financial markets, and that pose substantial risk to financial stability. So the idea is very simple. Suppose in 2019, that was before pandemic, and this business model run very well. And in 2020, when China end up into COVID, but quickly get out of COVID within a few months, and Chinese business and commerce recovered very quickly in 2020. And this business model still run perfectly well. And that proved that in 2020, the financial sector is still running well in China. And obviously, Ant Group business model still can sustain. However, and in 2020, people already worry about this high leverage multiplier could potentially pose risk to financial stability. And in retrospect, now we are 2023, right? So you know what happened in the last 2 years when the Federal Reserve hiked the interest rate from almost 0 to 4.5% within a year. So you can see how much the cost of borrowing could rise in such a short time period. So had the Ant Group Financial didn't change their business model, still utilize the high leverage rate in 2021-22, that would make that would make many of their loans completely unsustainable. And that eventually think of if Ant Financial's lending model collapse. For Ant Group, they only lost $2 per $100 loans. However, the rest of $98 losses will fall on the China's financial sector, including commercial banks. So that will put huge amount of a burden on China's financial system. So in retrospect, obviously, to put Ant Financial's IPO on hold, potentially avoid China to end up into a big financial crisis. And this probably is one of the perspective that from economists' point of view, to understand the rise and the stop of Ant Financial. And in 2022, last year, I think June 2022, so Ant Financial received approval by the China's Security and Exchange Commission in terms of allowing them to go back to IPO plan. However, they are still not making any substantial move until today. So the idea is very simple. Since end of 2020, when Ant Financial IPO was put on hold, they had done a lot of restructuring for their lending model, and then try to reduce the leverage multiplier, try to make their model more sustainable. And they probably want to avoid to making this aggressive lending model, continue with this aggressive lending model. So this is something that I can share with you as an example about what has happened in China's digital commerce or digital finance sectors. So there is a very interesting question coming. So why, if Ant Group had posed significant risk to financial stability in China in the last decade, why was Ant Group not properly regulated before its IPO? So this is a question raised by many people in China after this IPO instance was discovered. And one thing that commonly, one of the view people talking about in China is that many of the government agency, government officials, they acknowledge this great potential of fintech to facilitate financial inclusion. As I mentioned just now, many of the consumers and the small merchants who didn't have the credit record in the public system, so they have to rely on Ant Financial for short-term loans. So therefore, this is what we talk about, the financial inclusion for different group of people in the society. So government acknowledge this potential benefit. Therefore, they take a very tolerant view called wait and see, and to allow new technology and business model to first grow, to develop and grow before they impose further regulations on these business models. And there is another view, competing view or parallel view on this question, is about in China, the financial regulatory framework was for a long time segregated by industries and based on focused on financial institutions. However, Alibaba and Tencent, these are big tech companies. They were not categorized and were not grouped into as financial institutions. And therefore, the working rule for this financial regulatory system was as follows: whoever issues a license should be responsible for regulation. So think of, if you are the financial regulators, you probably need to think about, do I need to give a license to Alibaba? If I give a license, I add another something on my working list. So that will raise my workload. I don't have interest to do so. So therefore, I don't want to regulate this stuff. So therefore, with the new technology progressing in China, it becomes more and more urgent for the central government to coordinate different regulatory authority at the national level, at the central government level, to regulate, to assign this regulatory task to the proper authority to do this regulation. So this is a really reflecting desynchronization of financial technology progress or technology progress in general versus regulation. So this is interesting, observations that we can get from this case study. So regulation is always lagging behind technology progress, and this is very clear evidence for that. And of course, this is one of the example showing how powerful, how dramatic China's digital economy has been growing in the past decade. This is probably proved to be one of the success or in terms of facilitating financial inclusion using fintech. And in the meantime, the government regulate or contain the potential risk to financial stability properly. However, there's another case study that talking about the Chinese.
Sorry,
yes?
hi Ping, just before you move on to that, I just wanted to point out there was a question from Titus asking about the comparison between the sort of market share that Alibaba has in comparison to WeChat. Yeah.
So you mean this
WeChat?
one? Alibaba, which one? Which slide? Let me have a look at.
Oh, it was just in general. I think what you were talking about the
I see.
So I think penetration rates.
Yeah, for these two companies are very much like duopoly in the way that they are acquiring roughly the same market size. So Alibaba was coming to the market early, while Tencent, leveraging its WeChat, this super app, has been gaining the market share quickly. So in 2020-21, the market share in terms of mobile payment is roughly the same. So if you look at this chart, it shows that these two are roughly in the roughly same size, same magnitude. And I would say that Tencent is more like a social app-based, social app-based payment system, while Alipay is more likely online shopping-based payment system. So it depends on which generation we are talking about. For the previous generation about online shopping, people are more familiar with Alipay, with Ali platform. While for the younger generation, which their whole life are living on WeChat, they probably more frequently using Tenpay for their daily life. So both are, I would say half-half. And of course, there's the other digital platforms start to issue their digital wallet in 2020, 21, I think 2021, 22. So which is the parent company of TikTok. This is I guess you probably heard about TikTok, which is one of the I would say most popular apps these days in the US as well as in other countries. And the parent company of TikTok also run another mobile payment apps in China. So it also gained market share quickly. But still nowadays, Tencent, which Alibaba, they are two dominating players in the market. Yeah, let me see the question here. You know that.
Yes, thank you.
Yeah. And 23% of one of interest goes. Oh, I think this is a very, of course, what I share with you in this presentation is from economist point of view about the rise, dramatic rise of Alibaba and also Ant Group. And of course, there's if you ask a political scientist, they will offer you a different story for these facts. I wouldn't disagree on that part, but so in this presentation we will only focus on the economic motivations for the rise of China's digital economies. And I wouldn't disagree that government will play an important role behind this rise of Alibaba, as I mentioned here. So, of course, government take a relatively tolerant view about the rise of fintech. And of course, that is give a lot of space for these new technology company to rise. And yeah, so. And of course, the Alibaba story sounds quite successful in terms of pushing forward or promoting financial inclusion. However, there is another case study in China's peer-to-peer lending, so which doesn't seem quite successful. So peer-to-peer lending is very, I would say, very influential ideas in initially. Promoted by, I think, the very famous economist called Muhammad Yunus. So he actually launched the idea of microcredit. In 2006, the bank, he initiated Grameen, and Yunus was awarded for Nobel Prize for Peace. So for the contribution to promote this idea of microcredit. And since then, this peer-to-peer lending has been rising around the world. And one of the first China's peer-to-peer lending company was launched in Shanghai in 2006, very much like shortly after Yunus won the Nobel Prize for Peace. And however, peer-to-peer lending since then wasn't caused too much attention in the market. However, in 2012, I guess, in 2012, the government, both central government as well as local government in China, start to promote this idea. They believe that this fintech technology could completely change the way that people getting financial access, financial services, and also including lending services. And these support from government, from local government, as well as from central government. If you look at the central government annual work report in 2018, the government actually mentioned this P2P lending as a new format of digital or internet finance as a keywords in that year. And since then, there was both in the central government and local government level, a lot of peer-to-peer lending platform was launched. And you can see the number of functioning P2P platform as well as the monthly lending volume has been increasing from roughly 500 to 600 to over 3,500 within a year, within 1 or 2 years, from 2014 to 2015. However, of course, this online digital, this peer-to-peer lending platform sounds very attractive at the very beginning. However, if you follow up the news during that time period, there has been a dramatic increased amount of non-performing loans. So because peer-to-peer lending is actually has a great idea to overcome this financial intermediation. Basically, the borrower and lenders, they communicate directly. If you have money, you actually sign up on this peer-to-peer lending platform. You are offered all kinds of projects that needs funding. So you actually pick up the project you believe that which is promising. You will lend fund for that, and then if this project is successful, you will get payment for that. However, this financial disintermediation process through this peer-to-peer lending wasn't proved very successful because for individual, for normal consumer, normal lenders or normal lenders, they don't have the expertise to assess the risk and also they don't have information about the background of these borrowers. So therefore, many of these loans eventually become non-performing loans, and that causes a substantial widespread of default and bankruptcy of this peer-to-peer lending platform. You can see clearly from the peak of 3,500 lending platform in 2015, this number of platform has been declining dramatically. And in 2019, the number of platform goes to 600. And the government actually start to step in. They actually put a lot of regulations on that, try to avoid further spread out of this bankruptcy. And by launching various regulations from the central government as well as local government level, so eventually the number of the peer-to-peer lending platform eventually goes to 0 in November 2020. So you can see during very short time period, there is enormous amount of rise of this online novel fintech platform. And also this fintech platform didn't prove to be successful and eventually completely wiped out by the I wouldn't say by the government, but wiped out by the market within a few years. So this is a very dramatic example showing that there is a benefit and also there are potential risk, unknown risk through this digital platform. And by looking at the China's experience, that could be quite helpful for other countries to learn the lesson from that. And this is interesting too. By looking at Ant Group and also peer-to-peer lending, you can see the dramatic development in China regarding to fintech or regarding to digital economy. And this is basically regard to what we have been talking about just now. Not only about Ant, not only about the Alibaba and also Tencent as a duopoly in the mobile payment market in China. The China digital China's the market concentration for the many of the sectors in the digital economy are very high. So if you look at this chart, shows the e-commerce market share, almost 56% were acquired by Alibaba. And Jingdong, remember this one of the online platform that launched another online shopping festival, JD, account for 17%. And Pinduoduo is another low-cost online platform. So still, you can see that Alibaba almost dominates the entire e-commerce market. And for food delivery market share, Meituan is another digital platform, account for over 2/3 of the entire food delivery market in China nationwide. And for ride-hailing market share, basically the market share for like Uber. So Uber in New Zealand is one of the dominating player for online, driving market. So if you look at China, 85% of market share is acquired by Didi, which is the largest third-party taxi-style service providers. So these are very dramatic phenomena in China that cause concerns by the central government, or at least the regulatory authorities, because with such a huge market concentration, these service provider could abuse their market position and to acquire unfair market competitiveness. So which has been proved to be true. If you look at many of these merger acquisition in the last few years, these are mostly conducted by Alibaba, by Baidu, by Tencent Holdings. So these big companies, they are involved, they are engaging with innovation, that's true, but they also see a lot of potential competitors rising in the marketplace. So instead of competing with them, they probably merge or acquire these companies, which is the easiest way to enhance their own competitiveness and also reduce the potential competitors on the marketplace. So this is the this development since 2020 has caused significant concern by the regulatory authority in China. And of course, you probably see these things you probably follow this news in the US. So during the peak of the pandemic, middle of 2020, the 4 big tech companies in the US CEOs has been testifying in front of the US Congress to explaining whether they are engaging with unfair practice in business or abuse their monopoly market power in their separate markets. So similar things also happened in China. So China has been implement dramatic policy regulations or tighten up the regulations over big tech companies. So in 2020, 2021, before 2020, there were relatively little or relatively few regulation regarding to the fintech company or regarding to this big tech company. However, if you look at this chart, it shows you how frequent and how large scale this kind of regulation has been launched in 2021. So almost every month, there's some news coming up regulating particular industry, particular markets, and it covers almost everyone in this big tech company, big tech industries. So, however, the things get relatively slowed down in 2022 when many of these companies has followed the regulatory tightness, reform, upgrade, or comply to the regulatory requirements in 2020-22, and then recently the regulation become I wouldn't call that relaxed, but to become less the central government or put less I wouldn't call that less, but you will see less and less news on the public media about the government regulation regarding to these big tech companies. But anyway, I think this regulation will become more and more common in the coming months, or at least coming years, to put this big tech company under more stringent regulations. And yeah, so just a few updates to what have happened regarding to China digital economy. So just now we give you a big picture about what has happened in China in the last 10 years. And the government actually, as I said, take a reasonably tolerated attitude towards this rise of digital economy in China. In the meantime, they have been where everything almost going to a certain stage, the central government start to step in to recognize formally the data and digital economy as a substantial components of the production process. And last year, January last year, China State Council, which is the cabinet in China, issues the 14th five-year plan for digital economy, which is a very important document showing the roadmap for China's progress in digital economy. And almost the same month, the People's Bank of China released the FinTech Development Plan for the next 3 years. Also a very important document outline the roadmap for the financial sector to upgrade their service. And end of last year, the State Council published what they call the 20 points on digital economy, which is the implementation plan of their 5-year big plan. So the 5-year plan is reasonably put up the bullet points, while these 20 points on data economy in China is actually outlining the detailed implementation policy and measurements to implement this big plan. And just last year, when National People's Congress was held, the meeting in China, they approved the State Council's institutional reform plan that includes a few important new government agencies. For example, they established a new National Data Administration. So this is a different from what we conventionally regard as the National Statistic Agency. This is not National Statistic Agency. This is National Data Administration, which collect and coordinate the regulation, collect the data and also coordinate the regulation among different government agencies regarding to data economy. So as I mentioned just now, when Ant Financial was conducting their business, so they were not properly regulated. One of the reasons is that this regulatory assignments was not clearly specified by the central government. So no one knows who should regulate Ant Financial, at least in a more concrete sense. And this National Data Administration was considered as a coordination device, a coordination agency to facilitate regulation among different government ministries. And also China put a very important, put this intellectual property right protection at a very high level. They built a new agency, upgrade their National Intellectual Property Administration Agency as a top-level agency directly under State Council, which means that this intellectual property rights will become more and more important, will be highly recognized by at the central government level. And this is basically what I can share with you about the digital central government's plan. And of course, many of these people, I guess many of you are probably familiar that China has a very important commission called National Development and Reform Commission. They are actually not only, they are not designing the policy, they are designing the implementation plan for the policy designed by the State Council. So this National Development Reform Commission, last year, they released a new implementation plan. So it's a very concrete plan that will mobilize the funds and resources by the state-owned enterprises in China to build very powerful, very extensive data center networks. So the title of the plan is called Eastern Data and Western Computing. So basically, China plans to do in the next few years to build 10 national data centers. So including Beijing, Tianjin, Hubei, this basically surround the capital cities. And this is a Yangtze River Delta hub, which is surrounding Shanghai. And this is a Great Bay Area hub surrounding Shenzhen and Guangzhou and also Hong Kong. So these are three major data hubs that generating data. And how to process the data. They plan to build up another 7 data hubs in the Middle West areas, including Inner Mongolia, including Ningxia hub, Gansu, Shenyun, and also Guangzhou, Guizhou hub. These are the mostly less developed areas. It's not like in Shanghai or Guangzhou, in Beijing, such high developed places. These are Middle West or Middle West areas, which you consider as under the relatively less developed region in China. However, if you look at most of these regions, they have very rich natural resources regarding to energy. So including solar energy in Inner Mongolia, in Guizhou energy, basically hydropower energy in Guizhou. So they utilize this very low-cost energy source, which are sustainable, which are green energy. So use this energy to run the data computing center. So this basically is also another kind of a national plan to coordinate the resource allocation across the entire China by collecting data from the economic developed areas and do the data computing in the place where the energy cost is low and also utilizing the sustainable energy. So this digital technology will allow China to combine the upgrading to digital technology with the sustainable net carbon zero plan in China. So I think this is what I could share with you. Given the time limit, I probably don't want to touch too much about China's digital trade. So depending on the audience preference. So
might be interesting, Haiping, to say a few words about it.
Yes. Okay. So yeah, if time's allowed, we'll probably briefly touch upon this China's digital trade and also ICT trade. So for trade, if you look at China's involvement with information communication technology goods, including this device, electronic, basically device for the for digital platform. If you look at in 2000, so China's the ICT share in China's goods export was around roughly below 20%, and China's import was slightly above 20% in China's imports. So roughly at the same magnitude in terms of percentage share in China's imports export. And in the last few years, you can see clearly this number has been rising, both in terms of export and imports. So China's ICT industry has been closely integrated in the world network. I think you probably heard about the story of iPhone. iPhone is designed in California, and most of the components, parts are sourced around the world and eventually get assembled in China. So this is a very simple example about the global supply chain. So ICT goods in China is even more dramatic example for this global supply chain. So many of the components that China has been using, like smartphones these days, like Xiaomi, like Huawei, Xiaomi and other smartphone companies, they source their components around the world. They have the chip from the US, they have chip from Taiwan, and also touch panel from Japan, from South Korea, and also control panel from Germany, and they get assembled eventually in China. So this is a very prominent example of global supply chain and international production network. And these are basically regarding to the ICT trade in goods trade. And recently, if you look at the data from the World Bank, it documents data regarding China's involvement in service trade. So the ICT share in China's service trade has also been increasing dramatically. In 2000, this was negligible. However, in 2020, this number has reached almost 17%. It's very, very high. And we expect to see this ICT share in China's service export to continue to grow. Of course, given given this turbulent geopolitical and geoeconomic changing geoeconomic tensions around the world, it's not very clear whether this one will continue to rise. However, given the trajectory that we observed in the past, we expect to see that ICT share in China's service trade may continue to maintain a very high level. And this is a very interesting chart that I took from Merrick's webpage. It shows China's Belt and Road. It's not the Belt and Road we are talking about. It's a digital dimension to Belt and Road Initiative. It's called Digital Silk Road. I guess in the last few months, you probably heard from public medias about the China's involvement, China's engagement with France, with Brazil, with many other emerging economies, and also how much China has been connecting with the rest of the world through Belt and Road Initiative. And digital dimension is also worth mentioning. So before the pandemic, China has all kinds of plans, try to connect various parts of the world through digital network. This chart shows you various gigantic projects that China has been implementing or plan to do. And these could be another dimension that China would continue to connect with the rest of the world in the coming years. So this is the only data for 2019. We expect to see this updates from the webpage very soon, I hope. So that will probably give you a better, another view about how this China's digital connection with the rest of the world. And yeah, however, one thing we have to mention that China has very tight trade restrictiveness index regarding to the digital connections. So this is the OECD Digital Service Trade Restrictive Index. So it is commonly acknowledged that China has reasonably tight regulation about data, about data localization requirements, and also China put national security very high regarding to the data cross-border flow of data. And however, this one we will remain to see how this requirement would change in the coming years when China become more and more integrated with the rest of the world. We expect to see that China probably will gradually integrate with other countries' digital network in different ways. And this is a few recent development I think it's worthwhile to mention to our audience. The first one is about New Zealand, Singapore, and Chile has launched very influential agreement called Digital Economic Partnership Agreement in 2020. And 1 year later, China applied to join this DIPA. And DIPA joint committee has already established a accession working group for China in August last year. So we are waiting for the progress to see how far the China would join this new form of digital agreement. Another thing is related to the pilot program initiated by China, People's Bank of China, Hong Kong Monetary Authority, Bank of Thailand, and also the central bank in United Arab Emirates. So in last September, they completed a cross-border digital currency trial. So kind of cross-border digital currency payment system that's coordinated by Bank for International Settlements. So this is a very could be potentially very useful for China to continue to gradually promote its RMB internationalization through this new cross-border digital payments network. So given the current discussion regarding to US SWIFT, all the discussions surrounding US SWIFT, potentially this cross-border digital payment platform may serve as a parallel avenue for other countries to utilize. So Chinese company and also officials have been engaged actively in the recent years in many standard setting organizations and forums. So including in the international telecommunication unions, China has been engaging with these international organizations quite actively, try to participate in this standard setting in the last few years. So we expect to see the Chinese company and also government will continue to be more and more active in this dimension. So I think that's probably given the time limit, I probably will stop here.
I mute myself. Thank you very much. Fascinating. Yeah, fintech. Wow. Those of us who sort of wish we'd got in at the beginning. So it is time for us to have a break. So I think we will probably do a breakout session when we come back from the break. So I will put that question up for you to have a think about while we have our break. And if we could come back in 20 minutes for our break, or actually maybe 15 minutes, if we can come back at 15:15, and then we'll have our breakout session, and then Rob Scole will take over. So for now, I just want to say thank you so much, Haiping, for sharing your time and your expertise with us. It's always appreciated. Yeah. And then we'll see everyone in 15 minutes.
All right. Thank you.
Okay. Hopefully you managed to get a bit more conversation, and we will try and build in a bit more time for these discussions, because I mean, as you say, you learn a lot from each other. We also learn an enormous amount from you. So group one, that was Berhanu, Eni.
Hi everyone, good morning.
Hi.
Okay, so generally, I think across the participants of my group, we had the Uganda, Ethiopia, Ghana, Nigeria. So we all just noticed the same amount of growth in the e-commerce and fintech industry. And due to the globalization of the economy and the influx of social media, people have embraced the fintech and e-commerce method of operation. But the challenges we recorded or we saw so far is internet scam, the poor quality of products being delivered versus what you ordered, and that's just it. That's just the challenges so far. But on the positives, there is a massive increase, and like 10 minutes. There's a massive increase and digitalization of social media e-commerce all over Africa, I would say. Thank you.
Thank you, Eni. Group two, that was Velasco, Isaac, Lasedi, Margaret, Santo.
Yeah, for group two, I don't know if you're able to hear me.
Yes, we can hear you.
Yes, we can hear you.
All right, thank you. in group 2, there was Ghana, Zimbabwe, Botswana, and Eswatini. Unfortunately, we didn't get information from Ethiopia because I think he had problem with the internet. So I would just say in general, what we discussed, yeah, for these countries, what we've seen across is that we are still in the early stage of development as regard to e-transactions, doing e-trade. But one thing that we've noted is that we are now going towards that. There have been businesses that have been done online, shopping, and people have seen that there are a lot of advantages in doing that because you know, you don't have to waste your time going to shop, and then it's very efficient. At the same time, when it comes to those people who have physical maybe shops, they've seen that online is giving them more revenue collection because you don't have to like have to pay for a space for having a shop. So you would do the transactions just online. The other thing that we've also seen is that as Africa as a whole, there have been some formation of platforms such as African Continental Trade, a free trade area, as well as Junior, where they're trying to break barriers for trade, in trying to incorporate the most developed countries. So we've seen some positive developments, and we've seen that even the physical shopping people, they are now migrating to the e-trade. Of course, having looked at the advantages, we've also seen that there are some disadvantages because, or I would say challenges, because you'd see that most countries, internet access is a huge problem. And even if you have access to the internet, but now the cost of data itself, unlike the presentation that we saw with China, they would buy the internet for less than $1. For African, that is not possible. So the cost itself is very high. And we have also seen that the infrastructures themselves, they are not there. They're still underdeveloped, as well as the financial systems are also still underdeveloped. So those are some of the things that are hindering the e-trade in Africa in general. Thank you very much.
Thank you, Margaret. Group 3, Adil, David, Mankope, Nomazulu, Titus, Vusi.
Okay. Morning and afternoon, colleagues. Our group consisted of colleagues from Eswatini, South Africa, Zambia, and Kenya. What the common theme that we have across most of our African companies is basically that the e-commerce platforms are mostly driven, with the exception of South Africa, from mobile service providers, such as your MTN, Vodacom, etc. They have created their money platform apps, and mostly through the use of moving money, basically. In terms of entrepreneurship, that mostly happens through social media, WhatsApp statuses, Instagram, Facebook. Yeah, so that's mostly from a marketing perspective, and that's mostly the level of e-commerce trade. Yeah, there's no clear regulation regarding e-commerce per se. Yeah, and that could be said throughout Kenya, Zambia, and Eswatini. Security and fraud obviously becomes an issue, as well as data privacy, and lack of infrastructure amongst some of our partner countries. With South Africa in mind, I can touch on the major e-commerce platforms. I think we probably are a bit more advanced than our colleagues, probably from e-commerce giants that we do have. Takealot, which has a link to Naspers and Tencent to an extent. Our major retailers also have moved with speed with regards to e-commerce. We have our multinationals, Checkers, ShopRite Checkers, many of you might know in your countries, Pick n Pay, etc. And that seems to be taken off quite well. An interesting development within this particular space is Pick n Pay, one of the largest retailers, is actually partnered with government to actually move social grant access through that particular platform. So that's in discussion, and whether that will materialize and success, to what extent, obviously, that will come through. Yeah, within South Africa, we also have access to the general Alibaba, Amazon. I suppose that's with regards to the advanced infrastructure that is located in South Africa. In terms of regulation, a few years ago, data was an issue, the price of data. A social movement actually started called Data Must Fall. And that's actually helped brought the price of data down. So that was quite interesting at that point in time. Also within South Africa, you find a rise in a number of digital banks, formal digital banks, which have been opening up to compete probably within the same space. So I think within the past 5 years, there's already been 3 or 4 new digital banks, which have no physical addresses per se. It's all online via an app. So that's interesting also within the space. In terms of regulation, South Africa, we have the POPI Act, or the Protection of Personal Information Act, as well as the Consumer Protection Act. And there's also some debate around custom regulations for e-commerce, which seeks to try to strengthen or at least protect consumers bringing in goods and services through e-commerce means. So yeah, that's it for me. Thank you.
Thank you. Very, very interesting. Yeah, but especially the Pick n Pay government partnership. Very interesting. Room 4. Kabuni, Mojibola, Rachel, Stephanus.
Yeah, good morning. Yeah, I will be reporting for Group 4, which consisted of Namibia, Tanzania, Kenya, Ghana, and Nigeria. Most of the aspects are cutting across the African countries, but I would like to highlight specific issues in specific countries which emanated from our discussions. In terms of Namibia, although majority of the consumers are prefer to sell goods and services online, most of the issues also pick up during the pandemic, whereby people were exposed and then they had to make use of e-commerce and platforms which are provided for. Although there are a limited number of platforms for digital financing, like for example, MobiPay, the lack of trust and the reluctance by the consumers or by the users in the case of Namibia. In Tanzania, we have noted that there are no specific regulations with regard to governing of e-commerce, and there are only a few e-commerce developers. And as a result of this, revenue in terms of e-commerce market is projected not to be that high. The few existing users of e-commerce have partners mostly abroad, and there is still a need to strengthen or introduce infrastructure to support e-commerce in that regard. In Kenya, we have noted that there's a much development when it comes to connectivity amongst the Kenyans themselves, plus minus more than 20 million who engage, trade online and buy and sell goods amongst themselves, especially after the pandemic. People thus acted online and purchasing of goods and then selling of goods in terms of that. So those digital platforms are definitely there. And one interesting aspect also, the digital literacy rate of the citizens is to be commended, and that encourages the free trade in that regard, because the people are aware of what they are doing. In terms of Ghana, they also experience continued growth, especially after the COVID, of e-commerce trading and interactions. Penetrating rates have improved. Lots of e-commerce platforms for purchasing and selling of goods are available. The digital payment platforms are also there, although there are a few challenges with regard to the technical aspects, the legal regulations which are in place. Of course, cutting across, it boils down to some of the trust by consumers or the users or the citizens. Nigeria also alluded that they also have the platforms like the fintech access of financial products, mobile money outlets are open throughout, especially during the time of the pandemic. But they also highlighted challenges, especially after the central bank introduces the cardless product system in 2012. Some of the vulnerable customers were exposed to fraud, and when the fraud activities were reported to the law enforcement officers, the lack of skills also from the law enforcement officers hampered the investigation process, because the law enforcement officers did not have the know-how to investigate cybercrime. So in conclusion, perhaps what I would say is the aspect which comes out is the challenge is the lack of trust from the consumers. I submit from our group. Thank you.
Thank you, Stephanus. Yeah, fascinating. I mean, I think everywhere saw a sort of really massive and rapid shift to digital trade wherever possible because of the pandemic. But I think it really drove home the inequities in terms of infrastructure and, as you say, sort of digital literacy and you know, it's a difficult thing to quickly establish when you haven't actually been on that path already. Thank you all very much for the really interesting conversation. Rob, I'm going to hand over to you now for the rest of the session.
Sure. Okay, I'll just side by side speaker. Yep. Yay. So I'm going to can't get myself on the screen. I guess that doesn't matter too much. My speaker. Yeah. Okay, so I'm just going to share the screen with my slides. I can't get my picture on screen for some reason, but let me just get these slides online, share them, going to the slideshow. Oh, sorry. Here again. Right, okay, sorry, I've got that now. Okay, so thank you all. I just give my thanks also to all the groups for your feedback. I think with Haiping's wonderful summary of how things have developed in China and all of the observations and comments and sharing of experience from your countries, we have a pretty widespread picture of how the digital economy and digital trade has been developed, and also the issues and the challenges that arise as the digital economy and digital trade develop. So in the time that's remaining, I'm going to present a few slides. I won't be able to show all my slides in the time available, but I will try to place this topic in an international perspective to look at it as a global phenomenon, and what are the issues when we come to consider trade between digital trade between digital economies. I'm going to quickly go through these first few slides because they're basically simply saying how fast digital economies and digital trade have developed, but there's a wide range in the statistical estimates that we see, and part of the reason for that is that there is no internationally recognized definition of what a digital economy is, or even what digital trade is. And there is therefore no internationally agreed statistical framework for recording the size of digital trade and digital economies. But basically, we know that we have e-commerce, we have digitally enabled services, especially knowledge-intensive services being delivered digitally. We know that cross-border data flows assist with trade facilitation. They help with the management of supply chains, for example, by providing support services for smart manufacturing, by maybe sending through programs for operating machinery and manufacturing, and also the international operation of the digital platforms across borders. And then we also have something which hasn't been mentioned, but which Richard Baldwin in his book Globotics has highlighted, as the possibility of telecommuting instead of having to travel from one country to the other to promote oneself and promote one's services. You can actually be, in some jurisdictions, you can actually be present virtually in conversation with your clients simply by the use of digital technology. And that's something that, as it spreads and as that facility is available for developing countries, that will offer many ways to overcome the problems of being distant from the main markets. You'll be able to be there just at the push of a button. Now, I'll also just give you there a reference to, if you're interested in going into more detail, what are the issues that have to be faced when we're talking about the digital economy and digital trade in particular. A group that I'm associated with called the Pacific Economic Cooperation Council produced a primer on economic integration issues, which set out all of the issues that are involved for regulators and trade officials in digital trade and digital economy, trying to express it in as simple language as possible and without making any presumptions about what the right policy solution or the right policy approach is, but simply setting out what are the issues that all trade officials and all regulators have to confront in relation to digital trade between digital economies. So if you're interested, the link to that publication is there, and I'll leave that to you to look at your leisure. We have a huge range now of technology that's available. We've talked a lot about the internet and cloud computing. We're now talking increasingly about artificial intelligence, and one of the ways in which artificial intelligence can facilitate trade, in addition to what's already been mentioned, is that it opens the way for machine translation, that you can get documents translated to from one language to the other using artificial intelligence. You have the Internet of Things, 3D printing, quantum computing, all of which we haven't got time to discuss. And in fact, as far as quantum computing is concerned, I don't really understand that myself. The whole of the use of technology for digital trade is, of course, underpinned by the cross-border movement of data. Data is a means of production where it's providing the information that's needed for production to go ahead. It's a tradable asset because we can buy and sell data, and it's a facilitator. It's what allows global value chains to operate efficiently, services to be delivered efficiently, and also to facilitate or to enhance trade facilitation. And there's an enormous role for data in terms of managing global supply chains, logistics, planning and implementing transport logistic plans, financial functions, collaborating in research and development. All of these things are facilitated by the flow of data. And of course, as consumers, we can be educated online, we can have our health services provided online, we can be entertained by Netflix or whatever entertainment platform we want to use. We can shop online, as we've been hearing a lot during this session. We can manage our personal transportation and communication, as well as our employers, firms we work for, can also manage their transportation and communication issues as well, all using online data. So data really is the central commodity, if you like, in digital trade. And it is very, very different, of course, from other internationally exchanged items. It can be owned privately, can be used by its owners for both positive and negative effects. It can also be a public good managed by governments with implications for human rights, scientific process, and internet stability. And it is also the foundation for some of the cutting edge sectors in today's digital economy. Artificial intelligence depends on huge quantities of data analytics, and of course in some countries, advanced surveillance technologies also make use of enormous quantities of data. And so internationally, one of the critical issues is the governance of data. It's important, of course, domestically as well, but when we come to international linkages, data governance is really very, very important. It's also a source of market power. It's internationally, again, this is an issue that has to be confronted. Firms with more computing power are better positioned to extract and use data, and the firms with more data and more money are better positioned to exploit big data sets. And more data means more goods and services can be made available, again, and that generates more and more data and more market power. So there's a kind of a chain effect here, or a domino effect, which means that more data, more money means more money means more data, and so it puts enormous market power potentially in the hands of the biggest providers of online transactions. And of course, this also applies across countries because the data-driven firms are concentrated in the middle income and the wealthy countries, so that a lower income country starts at a disadvantage in not having the same access to all the advantages of massive amounts of data. And we have sort of obviously asymmetries and what advantages countries have in competing in a digital world. The United States and China in some ways are in the best position because they have the biggest companies, they have the biggest share of data and the largest data sets. They have a lead, they're at the forefront of artificial intelligence, and they have the highest digital profits. So that gives them a huge advantage internationally, although other countries are specializing in specific sectors, such as autonomous vehicles in the case of Germany, or machine learning tools in the case of Canada. But it's also important to acknowledge that comparative advantage in terms of which countries can most efficiently provide what kind of digital products, these can change as technologies change and the location of the technology of the innovation changes. So it's a very fast moving world where the competitive advantage and the comparative advantage of countries can change very rapidly. It's also important to note, and I'll talk about this in a minute, that both the United States and China have quite distinctive data governance models, as does the European Union, as I'll mention in a minute. But aspects of both the Chinese and the United States data governance models do have some aspects which can be socially and economically problematic. Here we have some more information about the rapid expansion of data flows. I won't go through that in detail. This is really just serving to emphasize that the flow of data across borders has expanded tremendously. This is we're talking here, for example, in a 12-year period, the amount of cross-border bandwidth in use growing by 148 times. So just an absolutely exponential increase in the rate of international exchange of data. So governments at the same time have got a range of interventions that they can use to governments have to have a range of interventions that they can use to restrict the flow of data, and therefore, just in some ways, restrict the efficiency of cross-border data flows, and thus restrict digital services trade and digital trade in general. So we see restrictions on cross-border data flows by many countries. These can be done for security, national security. They can be done for privacy reasons, as I will elaborate in a minute. They can also be done for reasons of international competition. So, for example, a country that has developed a new technology, say in some agricultural sector, I'm thinking here of New Zealand, but other countries too, that does not want to share that technology with its competitors, may decide to regulate that the data related to that particular technology should be retained within its borders. Also, giving an example from New Zealand, in our our indigenous Maori people, that data about their customs and their culture, or emanating from their culture, are considered by Maori as a taonga or a treasure, and they're extremely sensitive about giving access to people outside their culture to this data. And so the ability to manage who has access to their data is very, very important to them. And there probably are other countries where the same sort of situation applies, but that is certainly a situation that affects public policy towards digital economy and digital trade in New Zealand. So in addition to restrictions on cross-border data flows, we can have data localization requirements, which are the obligation that the data should be stored locally or domestically, or should be like, or the computing facilities even should be located domestically. So again, that can restrict data inflows and outflows. They can raise the cost of digital services by requiring multiple replication of the data infrastructure. But again, the cost of the restriction on cross-border data flows and data localization requirements has to be measured against the objectives that these restrictions are trying to achieve, so in which case have understandable rationales. In other cases, they're simply pure protectionism. So we have digital protectionism as a spreading phenomenon across the international economy. There can be technology barriers, so requirements to meet security standards which are unnecessarily stringent, or are incompatible between countries, or requirements to disclose the encryption algorithms or source codes. All of these things are highly controversial, and sometimes governments may believe that they're justified in making these restrictions, but in most cases they also involve a cost in reducing the efficiency of international data flows. There's also the issue of the setting of standards, which I should have perhaps mentioned on this slide as well. Setting digital standards is a very powerful tool of commercial competition. So you will find that countries like China and the United States, and maybe also the European Union, compete to have their standards accepted in their neighbouring countries, or even in countries further afield, as the standards in those countries, which then of course gives an advantage to the digital providers in their countries over the digital providers and their competitors. We have other more practical restrictions to internet use, things about issues with electronic authentication, electronic signatures, internet domain names. We have a country, Pacific Island country, not far from New Zealand, which makes money out of selling its internet domain name. And of course, electronic payment platforms, the way that they operate is very important to the efficiency of digital trade and digital exchange. So we also have big issues between countries related to the digital economy on competition and taxation. So the issue of regulating global and domestic natural monopolies is really important. The European Union and the United States have had some very intense conflicts over this. We've had US companies like Google fined by the European Union billions of dollars for breaking European Union's competition policy. We've had attempts to protect the domestic internet enterprises from foreign competition. And there is also an issue which has been very controversial in the United States called net neutrality and what that means for competition. What net neutrality means is that internet service providers must treat all internet communications equally and not give favors or lower prices to particular users, maybe users that they have a special relationship or which actually provide them with an incentive to give them special treatment. And this relates, of course, to the level of competition and market power in the digital economy. And there is a very strong move within the United States to introduce net neutrality and competition, but that is opposed equally fiercely by the companies in the United States that benefit from not having to observe net neutrality and competition. Taxation of internet companies has also been highly contentious internationally, as you probably know. The question about where internet companies generate their revenue and where they are resident for tax purposes, and if it's legitimate for them to be resident for tax purposes in different countries from where they generate the revenue. And again, this has been a huge area of contention between the United States and the European Union, and some US companies have been charged billions of dollars in back taxes by the European Union. Then we come to what is perhaps one of the most difficult questions, the question of privacy. How do you ensure the protection of personal data of your national citizens across borders? Should the data of your citizens be freely transmissible across borders, or should there be some restriction on the international movement of personal data? So in some cases with the European Union and its general data protection regime, digital protection regime, the GDPR, the General Data Protection Regime, complying with the privacy laws and regulations of the EU is made a condition for the transfer of data. It could be linked to data localization by requiring that personal data associated with citizens of a particular country should be physically located in that country. So we'll come back to this privacy issue because it is one of the internationally very, very contentious issues internationally. Governments, of course, are concerned to be able to get access to data of foreign citizens for national security reasons or for criminal investigations, which also brings up the question of cybercrime, intellectual property infringement, and that in turn leads us to issues of censorship and digital content. When we see digital spread of information like massacres in religious locations or mass shootings in the United States, should there be some limit on the extent to which those kind of events are allowed to be portrayed digitally without any limitation or restriction? Which again is a example of how governments will be, and maybe even societies will be concerned to protect their own political or social norms. And it has to be said that among these concerns, privacy has always been a major concern, but we're now seeing that national security is increasingly being given huge priority, not only, especially in the United States, but certainly not only in the United States. Many countries are focusing much more on national security, and we see that, for example, in the international debate about the treatment of TikTok. More and more countries are considering whether to ban TikTok on the basis of national security concerns, and fearing that the data that's collected by TikTok, which is very, very extensive, may be made available to the Chinese government. Whether that's a justified fear or not is another question, but we don't have really time to go into that. So let's just look at, first of all, as an example, the differences between the European Union and the United States on protecting data protection regulation. The European Union has a one-size-fits-all approach where protecting private information is regarded as part of the protection of human rights, and that extends to cross-border data flows. So under that approach, to collect and process personal data is prohibited unless there is an explicit legal basis that allows it. So unless you have a law which allows you to collect the particular data that you have, collecting that data is actually illegal in the European Union. So data can be collected only for specified, explicit, and defined purposes. And this is the idea in the European Union to minimize the collection of personal data to the extent that is absolutely necessary. And there is a data protection directive in the EU which establishes common rules for information privacy among the EU states, which as usual with these kinds of directives in the European Union, has been enacted or has had to be enacted by the individual EU members in their domestic legislation. And then we have the General Data Protection Regulation in the EU. It's the famous GDPR, which came into force in 2018, which extends the scope of EU data protection to all foreign companies processing data of EU residents. And the enforcement is pretty strict and the penalties are pretty severe. Some companies have been fined billions of dollars for breaking EU GDPR restrictions. So not only within the European Union, but between the European and other countries, this definition of the legitimate purposes of data collection and use is clearly defined by the GDPR. So if we are trading data with the European Union, or we are engaging in trade which requires the transfer of personal data, we need to comply with the European system of GDPR. So the legitimate purposes of data collection are listed there to, so if the subject is given consent, or there's a contractual obligation, or there's a legal obligation to collect the data, or to protect the vital interest of the subject itself, perform a task in public interest or under official authority, in other words, government's data collection that's legitimized by the government itself, or for legitimate interests of a data controller or a third party. So if the data being collected is not justified by one of these purposes, then the collection of that data under the EU's GDPR is actually illegal. Contrast that with the United States, which has a patchwork privacy, it wasn't really called it a system, but a patchwork approach to privacy, where collecting and processing personal data is allowed unless it causes harm or is expressly limited by US law. And privacy is...
Sorry, Rob, I think you were a couple of slides behind. I'm just looking at you. The slide we're seeing is still on the other areas of tension around digital trade.
Oh, sorry, I thought I'd moved that on. Okay, so where are we? We're there. Is that what you're showing on your screen?
I'm still seeing the other areas of tension around digital trade.
Okay, I don't know where that's going. I think, am I behind?
Yes, I think so, because I'm looking at the slides you sent me, and I'm pretty sure you've moved on from what we can see on the screen.
Okay. Okay. I thought I was showing the slides that I'd sent you, but
oh, you are, but you I think have, in terms of what you're talking about, moved on from this tensions around digital trade.
yeah.
But the slides haven't moved on.
Okay. Well, I was on this slide here talking about the EU's GDPR and the US system of privacy.
Not what we're seeing.
Are you seeing that?
No, we're still seeing the tensions around digital trade from 2 slides back.
Okay, well, how do I move this? How do I move this on? If I'm moving it on my slide, my screen, and it's not moving on in yours.
Perhaps the easiest might be to stop sharing and then just reshare.
Oh, okay, I'll stop share. I'll do that. Right. Okay. Okay, so I'll share screen again, and I'll go back to the slideshow, and so are you seeing data transfer regulation between the United States, EU, and the US there?
Yes.
Okay. So I'll go back to that, an example. So basically, this is the slide I was talking about. Are you seeing that now, the US patchwork approach?
Yes.
Okay, so I won't go, we've taken up some time with this. I'm sorry about that, to apologise to the participants. I'm not quite sure what happened there. But basically saying that the US has a completely different approach to privacy from the European Union, where there is no overall legislation. It's on a sector by sector basis. The protection of data may be different for different types of data recording. And if the information doesn't fall into a particular category that's covered by law, it's probably not protected at all. And so the US doesn't limit companies' export of information to other countries. So there's no restriction on cross-border data flows. So given that you then have enormous amounts of trade between the United States and the European Union, you have a real, and much of that trade in principle requires the transfer of individual or personal data. That's been a huge problem in trade between the United States and the European Union. And I won't go through these next two slides in detail because it's very detailed, but essentially it details the attempts by the European Union and the United States to produce an understanding on the transfer of personal data, which would allow personal data to be transferred between the European Union and the United States, given that their two systems are quite different, and given that the European Union actually insists that countries that it exchanges data with should follow its own system. So basically, you've gone through several years of attempts to find a solution, and there is no solution as yet, as far as I know. It's also the case for other countries. So, for example, in New Zealand, if we are engaged in transactions that involve the transfer of data between the European Union and New Zealand, for those transactions to be deemed legal or transfers of data to be deemed legal by the European Union, it's necessary that our data privacy regulations or laws are deemed to be acceptable by the European Union. Okay, I had a case study here of the coverage of cross-border data flows in the Trans-Pacific Partnership, which was originally an agreement between 12 countries in the Asia-Pacific region, including the United States. The United States dropped out, and so it became an agreement between the remaining 11 countries called the Comprehensive and Progressive Trans-Pacific Partnership, which is CPTPP, which is often regarded and claimed by some of the CPTPP members to be state-of-the-art regulation of cross-border transfers. So I'm just summarizing there what the CPTPP chapter on cross-border data flows does do. It does certainly set some standards in some important areas, but what it doesn't do is resolve the kind of problems that arose between the United States and European Union on ensuring effective privacy protection between countries, or balancing national security against the free flow of data. So there are some of the really crucial issues involved in the regulation of cross-border data flows are not addressed at all even in this so-called state-of-the-art or gold standard chapter on cross-border data flows. And you'll see there noted through that list of the provisions that there are still some problems with the provisions that it does have. So that really highlights how international regulation of cross-border data flows is a really, really difficult international issue, very difficult to find solutions to. So so I'll quickly move on to this question of strategic rivalry in digital trade, which is one of the things that really bedevils or frustrates any attempt to produce an international standard on a global basis on digital trade. We have three major players, the United States, the European Union, and China. Some people call them the three digital kingdoms, and they pursue and exemplify quite different approaches to digital trade, which makes it difficult to come up with a internationally agreed approach that would cover all digital trade. These positions have been developed over 25 years, and they really reflect three different visions of the digital economy, which, as I say, is has big implications for whether global digital trade can be integrated globally or whether it will become fragmented across between trade involving each of these three digital kingdoms, and that in turn has implications for the costs and benefits of digital trade, which are basically consistent with what we see about what we say about the costs and benefits of international trade in general. That the freer the trade, in terms of allowing trade to flow freely between all countries in the world, the more beneficial that is to the international economy in general, the countries in the economy. Same thing in principle applies to digital trade, but it's very difficult to achieve that because of the different approaches taken by these three digital kingdoms. The United States has a very large first mover advantage because it's digital tech giants, it's digital firms like Google, Amazon, Microsoft, etc., Meta, very, very large firms who had enormous initial economies of scale in the tech sector because of their access to data, so that they could basically add more and more customers to their portfolio with very little cost. And they achieved virtually total market dominance in some aspects of the digital economy. And understandably, perhaps the United States wants the maximum openness for digital trade and digital economies to allow the competitive advantage of the US tech giants to be locked in permanently. And of course, the European Union and China, among others, are not particularly enthusiastic about that. The European Union doesn't have the same kind of tech giants that the United States has. There's no Google in the European Union or Amazon. But it's added data flows to the list of its 4 freedoms that it applies to trade within the European Union in what they now call a digital single market strategy. It does concern itself with the adjustment costs and risks of digital transformation. So it has a social conscience, if you like, in relation to what happens to societies as a result of digital transformation, which we don't really see in the United States. And it has been a strong proponent of regulating the digital economy, again, in contrast to the United States in certain areas, especially on privacy, but also in competition. And so it's clashed continuously, really, with the United States on privacy, competition, and tax in the digital economy. And as I have mentioned, some United States firms have been fined literally billions of dollars because they breach what the European Union considers its rules on competition or privacy or tax. China, you've heard a lot from China, from Haiping about China, so I'll cover this very, very quickly. Originally, China was playing catch up in the digital economy, but it was able to exploit the advantage of market size, its huge population, and a huge amount of data available to its firms to accelerate progress to the point where it's now one of the 3 key players in the world digital economy. And in some areas, as Haiping highlighted, it's actually ahead of the field. Maybe in fintech is one example of that. It does not share a commitment to open digital borders. So we have this sovereignty, insistence on sovereignty over its cyberspace, what some people call the Great Firewall. Although I have to say that anecdotally, it seems to me, and even Haiping, I think in conversation has confirmed this to me, that the Great Firewall can actually be penetrated by citizens inside China if they wish and if they know how to do it. So it's not as, but it's, I guess, much more difficult for foreigners to actually penetrate the Great Firewall unless they know somebody in China who can help them. They have a cybersecurity law in China laid down that physical data must be stored in China, so there's data localization. They have mandatory inspections of digital equipment. They have requirements for what data should be retained so that the government perhaps can ask for it in the future. And they have a very different approach from the European Union in particular to privacy and to the European Union and the United States to freedom of expression. With, of course, we know that there is significant censorship, and we have the development of social credit, which operates as a kind of a national social monitoring system, which operates on a point system collected through the use of artificial intelligence. But I think sometimes that's overemphasized in the West because although the censorship does exist, and I think China would acknowledge that, they have the social credit system, the online environment in China is actually extremely dynamic. And at any one time, and particularly when some controversy erupts in China, the internet in China actually explodes with people making comments. And I think perhaps this is only my personal assessment or personal sense, that it's possibly the case that Chinese people develop a knowledge of what topics they can discuss freely online, and they do discuss those topics very freely. They also know what topics are kind of off limits. That's just my personal sort of assessment that I've come to by looking at both the existence of censorship and the fact that the online activity in China is very, very dynamic. They created a technologically sophisticated parallel universe within China, which Hai Ping has described. So I won't really go say anything about that, except to note that China has very ambitious objectives for its artificial intelligence sector. And big questions, I think, arise for China, which China will have to find ways of addressing, is how do you reconcile the objectives of becoming a leader in artificial intelligence with all that implies in terms of the availability of information, to the concern that China has to maintain political stability, ultimately controlled by the government in China. So, but I think it's also true to say that China understands these issues, and they are sort of actively working to find answers to those questions. As I said, as Hai Ping demonstrated, and as I mentioned, China is perhaps now the world leader in fintech or digital financial services. It's developing a digital currency, which will, what they call the central bank digital currency, which is intended to be used domestically, but which also potentially could be used in international transactions. And from the point of view of China and some of its trading partners, one of the significance of a digital renminbi or digital yuan, the Chinese currency, is the possible potential to sidestep what might be any attempt by the United States to use the status of the United States dollar as a international reserve currency to apply sanctions to some countries and maybe in the future to China. So that's a question of watch this space. I think the digital renminbi is a long way from being able to realize that potential, but it's clearly in the back of the minds of the Chinese officials that the digital currency may be a way of escaping from the power of the US dollar in terms of restricting international transactions. Hai Ping made clear just how rapid the growth of digital finance or fintech in China has been. I don't need to go through this slide, I don't think, in any detail, except to perhaps mention that in terms of interpretation or implications, if we go back a little bit further in Chinese economic history, we find that the question of whether and how far to liberalize financial markets has been a huge policy question in China, related to the role of the commercial banks, many of which are state-owned banks and which have been historically inclined and sometimes directed to provide preferential finance to state-owned companies. Liberalizing financial markets essentially means reducing the power of those commercial banks. And essentially what's been achieved in China is a backdoor liberalization of financial markets through fintech, which actually addresses a number of questions that have been debated in China for decades. Of course, there is the question of increased financial risk, which Hai Ping mentioned, and the way that the Chinese regulators let the fintech develop without imposing strict regulations. That's in contrast to the practice in many countries, including my own, where the tendency is to make sure you have the regulations in place before you let the system operate. The Chinese let the system operate and then thought about how it should be regulated. So the regulation was actually developed as they went along, which is a very interesting approach. And you heard from Hai Ping what that meant in practice. And I've talked here about again about the digital renminbi. Big question really about how far that can go internationally is how far China is prepared to let the renminbi become internationally convertible. I mean, that applies to the I suppose you could say the non-digital renminbi. That's been a question for many, many years for China, but that will also be a question for the digital renminbi as well. Will they be prepared to make it fully convertible, which is really an essential condition for the digital renminbi as being accepted as a alternative to the United States dollar in international transactions. Haiping mentioned the Digital Economy Partnership Agreement, so I won't cover that at all. Just to mention that there are a number of venues where approaches to digital economy are being debated, and efforts being made to develop principles among the G20 within APEC, the Asia Pacific Economic Cooperation, where the big divisions between China and the US are an obstacle to making progress, but APEC has developed some quite far-reaching agreed roadmaps or action agendas or privacy or and a cross-border privacy rules system. How far that can be implemented really is a question of whether conflicts between the United States, China and Russia also can be resolved, all of those countries being members of APEC. Then finally, if I just quickly mention the WTO work on the e-commerce plurilateral, sometimes called the JSI process, the Joint Statement Initiative, which was the joint statement was a statement made in Davos several years ago to endeavour to produce a set of agreements on how to regulate international commerce globally, put in place global rules on international commerce, accepting that this couldn't be done within the WTO as a whole, but bringing together those members of the WTO that were prepared to try to develop global rules on international electronic commerce. And so they're first of all looking at rules to improve consumer trust, tackle barriers to cross-border sales, guarantee the validity of e-contracts and e-signatures, ban customs duties on electronic transmissions, which, as I've said, was very controversial for some developing countries, and address the forced data localization requirements and forced disclosure of source code. So these are basically the issues that business would like to see resolved in order to maximize the potential of electronic commerce. And then there are also, of course, some of the really contentious issues like cross-border data flows and the issue of privacy, the moratorium on the customs duties. These things are also being discussed, but with much less hope of an early resolution of those issues. So what's happened so far? There's a surprising amount of progress been made on this WTO e-commerce plurilateral initiative, which, as I said, is not an initiative involving all WTO members, only those members that have chosen to be involved in it. So a plurilateral process. So they've managed to agree on clean texts, which have apparently been agreed on electronic signatures, e-contracts, electronic contracts, spam, open government data, and online consumer protection. There's a text on transparency, which is said to be near to being finalised. And the chairs there are various negotiating groups in this e-commerce plurilateral, and the negotiating chairs are trying to push for progress on some of these really key issues, really difficult issues between the members on data flows, localization, source code, and customs duties on electronic transmission. So the really difficult issues, understandably, have been left to last, and there are still questions about whether the plurilateral can crack those issues and reach some kind of international agreement. It's a big challenge, and recent events internationally won't have made it any easier. There's also a text being developed for paperless trading and open internet access. So I'm sorry I've gone a little bit over time, but I tried to sort of set the whole issue of digital trade in a international context, where you can see how the superb presentation from Haiping on China's digital economy, where that fits in internationally, and also where other issues are coming from within the international community on digital trade and digital economy. So hopefully that's provided some sense of digital economy and digital trade as a global issue. So my apologies for keeping you away from your work or your breakfast. I hope you have a very good day.
Thank you so much, Rob. Yeah, I mean, to be fair, this entire course could be on digital trade and we'd probably still run out of time. It's such a massive and complex thing. I'm sure our brains are all very full now, and you all have a work day ahead of you still. So I will close very quickly with a karakia, and then we will see you and Rob again tomorrow. Kia tau, kia tātou katoa, te aio, te aroha, me te maruto, tihe mauri ora. That just means may peace, love, and safety be upon us all. So be well, go well, and we will see you tomorrow. Thank you, everyone.
Thank you.